uh, then we will talk about the most important thing going on. Hey, everybody, thanks for joining today. We've got really an amazing guy, John Berlet, a lifetime of working with investors, has been managing his own fund for quite some time. But what I really like about what he's doing is he's got a different focus than what most of the active deal makers, the active real estate investors have been doing. So I want to dive a lot deeper into these tax deeds, but we're actually in the middle of a conversation, and it's the most important thing. We're talking F1 racing, and they're just in Austin, Texas this past weekend. And we've both been in the past. I don't think we either. Well, I know I didn't make it this past weekend, but it is amazing. So, John, when you went to the F1 races, was it already the time that they went completely electric, or was it still the gasoline?
No, it was the inaugural year. And
okay.
I had a good friend, client who invested heavily and turned out to be very profitable in box seats. He bought like eight seats, and he sells them every year. But anyway, my first year I attended, we rode buses from downtown Austin out to the track, which is probably 20 miles away. And I noticed the amount of European influence attending there. Spain, people from all over the world. It was a big coup for Austin, no doubt. On top of ACL weekend, following up, Austin's just nuts.
It is, and that's how all of October is. The first weekend is Austin City Limits. The second weekend is Austin City Limits. I was just down there for the second weekend. Amazing music. And then the third weekend is the F1 racing. So October, Austin is just the place to be.
For sure.
So, all right. Well, John, thank you so much for going down some tangents with me and joining today. We've worked together for a number of years now, and really want to get a little bit more into your background, because honestly, for everybody that watches, what your career path has been is kind of that ideal for somebody that's going to be successful starting, capitalizing, and managing a fund. So I definitely want to focus a little bit on that in the past. And if you don't mind, I mean, you were a financial advisor, a stockbroker when there were stockbrokers.
Well, let me correct you on that. I was never a stockbroker. I did have a registered investment advisory firm in Austin. And I focused on retirement income planning, tax planning, Roth conversions. Income planning was my niche. And we go way back in that space. I used a product called fixed indexed annuities issued by life insurance companies, and ended up being very successful helping people with their safe money. And I kind of referred to as a safe money guy with a passion for real estate. So I ended up selling that book of business in 2021 to a law firm that does estate planning type work, and resulted in a capital gain event, which caused me to begin a deep dive in this new tax incentive called qualified opportunity zones. So
that's where we first connected.
Yeah, we did somehow, and I think in your young days in San Diego, you were on board with FMO that I was affiliated with, that helped in the marketing side of getting a new fixed index annuities. Were pretty new. They only came out in 95.
Oh, yeah.
And so I started in 99, and they're really a great tool for some of everybody's money.
And just to speak to that for a second, because just to give my little diatribe, because I was in that industry for a long time. You brought up an FMO. The company that I worked with was Asset Marketing Systems, and we were helping financial advisors, and really the focus was annuity sales guys market and get in front of more clients. That was the entire thesis of the business. If we can get you connected with more investors, you do better, we do better. And I want to bring that up, and that was really focused on annuities, but that's actually been the basis of my entire business now, going back 20 years. After I was doing the wholesale annuities, I got that itch of like, I went to law school. I guess I will become an attorney. Then I became an attorney, but all I've ever known is investments, working with investors, marketing for investors, which led me to, well, this business of helping people get more deals done. But where asset marketing systems really came into play is helping people find more investors, how to market, how to sell more investors. And that's how I approached every one of my clients, with that same concept of, if you can find more investors, we all can do better. So that's been the entire thesis of my business. That brings me really, even 20 years later, to today. With crowdfunding lawyers, we so much focus on how do we help you find more investors? You get to do more deals. You do better. We do better. How do you sell more investors? And how do we just make more good stuff happening? Last month, talked marketing for the entire month. This month, talking about different investment asset classes. And that's where, John, you are focused in it's been around for a long time, but there hasn't been a huge amount of focus on tax deed purchases. Before we get to that, and I really want to dive in deep with the tax deed purchases, what they look like, the benefits, but I want to hear a little bit about your experience with going from financial advisor, selling annuities. And annuities, it's a great balance with these funds. You have more of the private, higher risk versus reward, the lower risk versus reward, meaning you get a lower return, but there's some level of safeties. You never say guarantee, you never say safe, but there's less risk. There's also a lesser return there. So when you went from financial advisor to fund manager, tell us a little bit about your experience. And I mean, it's a huge pivot, but how's it been working so far?
Awesome. So I mentioned I sold my book of business to a law firm, and I thoroughly enjoyed income planning and getting people from taxable accounts to tax-free via Roth conversions. And a lot of our listeners and a lot of your clients, I think, are under the impression they're not eligible because they make too much money to contribute to a Roth. And that's very true. There's income limits. However, there's no income limit to converting. So those of us who have some sizable retirement accounts, there's nothing preventing you other than paying Uncle Sam whatever chunk you want to convert. So Roth conversions, I loved, and I always had a passion for real estate. So in 1993, I was living in Lago Vista out on Lake Travis, and I read the local newspaper said, economic woes reach around the world to the Texas Hill Country. Long story short, the Japanese had bought the golf course, the country club, about 700 lots in Lago Vista, and they were going to start selling those lots at the courthouse steps for the amount of the back taxes. And that got my interest, and I had, meantime, I'm considered a pioneer in the self-directed IRA space, by the way. John Heyer, who's a pretty well-known tax attorney, coined me as a pioneer. So I had a little IRA that was self-directed with a company called Sterling Trust, who got acquired by somebody else. And I went to this tax sale in June of '93 in Austin, Texas. And there was only two of us at the sale, myself and an attorney by the name of Walter Winland. Walter was a sage old real estate attorney, and he told me there was 13 properties for sale. And he said, whenever I bid, you don't bid. And if you want to bid, I won't bid. I said, okay. So we bought everything at opening bid. I bought 3 lots. He bought 10. Now, today, I know that's illegal. That's called collusion. And I had no idea, that was such a thing.
Oh, you trust the attorneys. We never do anything wrong.
You're right. I actually went to a seminar a year ago at the National Tax Lien Association puts on, and they had an attorney with the SEC, not SEC, some regulatory authority speaking about, when you bid on federal deals,
jobs, the contracts.
Contracts, yeah. They have something, and she addressed it at the National Tax Lien Association that it's illegal for these bidders to plan and kind of do what I did 30 some years ago. But anyway, I bought
Well,
three.
we won't hold it against you 30 some years ago. I think the statute of limitations is passed.
Hopefully.
You're safe.
Okay, hopefully. So Walter went on and had 10 lots, and he built some duplexes. I had 3 lots. One of mine was, I bought $1,100 and some change, sold it for $38,000. So do the math. That's huge ROI on that one lot. Had some great successes. All along, I'm still building my practice, doing seminars, talking to people about their safe money. But personally, I'm investing in real estate. I don't know if I answered your question about how I made that transition.
A roundabout way, and you told me the birth of it. We haven't gotten to the transition yet, but something that you brought up that I think is super important. Well, to begin with, you talked about seminars, and in the 90s, early 2000s, the seminar process was a great way to find investors. Mm-hmm. That has very much gone out of vogue. Not many people are doing that anymore. It was a matter of spending $30-ish on a meal for a prospect that may or may not ever actually buy. Yeah, we've all done it.
You remember what we called them in the business?
I don't. Besides
plate liquor.
Plate liquors. Yep. Mm-hmm. I remember the plate liquors. I just understood them as a buying unit. Now it's just my job to make sure that they buy.
Mm-hmm. So that's where I built my book of business, and it was a lot of fun, and met a lot of clients, and ended up earning their trust. So many of them, because when the downturn of 06, they all on these fixed index annuities got zeros and never gave back any of their gains. So I'm kind of the hero. It's shocking to me. We're on a 14-year, pretty much. Bull run now, and I expect a major correction. Just all I know is we're one day closer today than we were yesterday.
But people have been talking about that since 2016, 2017. I've come to a new belief. There is so much wealth in real estate, not just for the middle America with their homes, but with Wall Street, and more millionaires made off real estate than any other industry in America. Mm-hmm. What we've experienced over the last 20 plus years is every time there's a financial issue, amazingly, the Fed or the government acts as a backstop. They're there to make sure things that don't go too wrong. And I think that there's a lot more confidence nowadays that if there was a serious correction a la 2008, the government's going to jump in there, especially with the big money investors that are now in real estate that weren't in real estate back 14 years ago. God, 16 years ago. It's been a long time. We are not spring chickens anymore there, my friend. But at least that's where my confidence comes in I think things are going to keep going well for the long term, although the asset classes and the places to really make money are shifting. And that's where I really want to talk to you and about what you're doing, because it's so unique compared to what other people have been focused on. And other people need to know about tax deed sales and how to invest with it and how to, if there's an opportunity to work with you, I don't know, but these are the things we're here to talk about.
Well, let's jump into it. Let me preface my focus on educating basically the priority of a tax lien. And every state, Nate, is so different. It's state specific. Mm-hmm. About half the states are called lien states, where the investors are bidding on how much interest they're willing to drop down to have a lien, take the position of the property assessor, the school, the city, the county, whoever's taking the lead on that collection. Usually it's the county. So what's happened now in Texas and many states, we've got a huge run up in the valuations. And these tax collector office, tax assessors tend to be a year, 2, 3 years behind on the curve. They finally caught up with us. Are you keeping aware of the Denton County tax collectors litigation?
I know, but I know that they're killing me both on commercial properties and residential. So I feel like I'm paying them at all ends.
Do you
And
own property in Denton County?
Where do you think I'm sitting right now? I
Up in
live
Denton.
in Denton County. I'm located in Denton County. I'm office in Denton County. I'm exactly where you're talking about.
Well, I need to send you a link to a man by the name of Mitch Vexler, who has some litigation with Denton County over 6 years, and he's really astute person, and heads are going to roll there in Denton County, and I'll shoot you that link. But long story short, there's some fraud involved. I had an ad valorem property tax consultant license for about 6 years in Austin. I represented over 400 property owners at the appraisal review board, so I have some insight on that. And that helps me now as we're buying these properties at tax sales. I certainly protest every one and present a pretty good case because I have a sheriff's deed. So let me go back to the dynamics of tax deeds. In Texas, which is what I know best, and there's only 4 other states that are similar to Texas where you get a deed. It's called a sheriff's deed day one. If you're the highest bidder at the tax auction, you get typically you're the owner as soon as you record that new sheriff's deed. You go on record. Okay. Subject to the prior owner's right of redemption. The state statutes say that the tax sales, the litigation, there's what's called a judicial foreclosure, where a law firm is engaged by the taxing authorities to present suit against the delinquent taxpayer, usually 2 years or more of delinquency. And then they have to go through the entire process and file the suit, and then they bring it to sale. And by state statute, the sale has to be conducted on the first Tuesday of the month at 10 a.m. at the courthouse steps.
Now, I just want to mention this is very Texas specific for everybody that's watching everywhere else.
Yes, and which is what I know best. And we bought one in Oklahoma. Our first 10 we snuck over the straight line and bought one in Oklahoma. But anyway, my counsel has advised me to not expand into other states yet until we really, nail it here in Texas. Anyway,
and I know that there's a huge emphasis or focus on Texas for this. You mentioned Texas is one of 4 states that allow for the sheriff's deeds. Are you aware of, in a general sense, in the other 46 states, how it works with getting a lien, then foreclosing on it? Like, why is it different and more favorable to be here in Texas?
Great question. So I am aware of Colorado. I bought 2 properties at a tax lien auction, and I'm a member of the National Tax Lien Association, which has a wealth of knowledge and experience. And there's more players in the lien states than there are in the deed states. But the states, there's 5 of them: Texas, Georgia, Tennessee, one of the Carolinas, and Hawaii are what's called redeemable tax deed states. And what that means is the prior owner has a right of redemption. And if the property is non-homestead, non-ag exempt, that redemption period is a short 6 months, 180 days. Okay. If it's a homestead property, they have a 2-year right of redemption. Or if it's an ag exempt, there's a 2-year right of redemption. If they are able to redeem the property, they have to pay us and our investors what we paid plus a 25% penalty, which in effect is a 50% first-year yield on the non-homestead purchases. And in the homestead purchases in Texas, the 2-year right of redemption says they have to pay us what we paid plus a 50% penalty if they redeem in the second year. My niche, Nate, and we're focused on properties that's unlikely to be redeemed. In my track record, over 60 properties I bought prior to launching this Reg CF offering through your firm. and your counsel was 61 properties I bought. Only 3 of them were ever redeemed. So far that we bought 10 in this new offering, core tax deeds, since May. We bought our first property in May of this year, and we have bought 10. Only 1 of them was a homestead. So we stay away from the longer by purpose. And there's some other strategies that we utilize. We don't bid in the major metro areas. We're not in Dallas, Houston, Austin, because of the competition. I mean, there's people, hedge funds bidding at these auctions, driving the prices up, 60 cents on the dollar, and, doesn't make sense. So we stay at least 2 counties away from the metro areas. We're in the tertiary markets.
And I love it. So when do you personally show up, or do you have like a company that you work through that shows up at the auctions on your behalf? Like, how does that work?
Let me tell you, we have 4 managing member partners in the management team that manages this fund.
Okay.
And they're all boots on the ground, and they all have skin in the game. They all put in between $25,000 and $50,000, and they're going to look at the properties. 254 counties in Texas. It's a big state.
Yeah.
We could raise all the capital we want to raise and deploy here within 12 months, which our goal, by the way, is $5 million. Anyway, I do have managing member partners who look at the properties, and they attend the live auctions. So in the last 18 months, the trend, we're way behind the curve in Texas, is trending to online auctions. So about 30% or less of Texas counties are now selling the properties at an online portal.
Okay.
You have to register. It's cash on the barrel. You got to wire the money that day. Even if you're at a live auction at the courthouse steps, you got to pay cash that money that day, whatever your bid is.
I think that's a huge point. So if it's a $80,000 buy, you've got to be ready to wire $80,000 the day you purchase. I think that's pretty important, because some states, I know it's like, as long as you put $10,000 down, you have 30 days to close. Others, as long as there's $2,000 down with intermittent payments. Like, I know different states are different ways. Mm-hmm. At least in Texas, you got to be ready to pay the entirety same day.
I found there's a few counties, very few, that will, for some reason, they'll let you get the money in the next day. Oh, I know. There's one county we bought, by the way, we bought 6, we get a huge, I'll get into some of the properties if time allows, but we got a huge windfall coup on an acreage tract up in northeast Texas. And they allow us till the next day to get the money to them for some reason. Okay. It's a different law firm, a different portal that handles the sales. I guess every county a little bit, even Texas is different than other states, and counties are different within the state. But we bought 15.6 acres for $20,100 near the Shreveport, Louisiana state line, full of piney trees that's ready for forestry trimming. Mm-hmm. But we later found out right away, within 3 weeks after the auction, that we acquired 80% of the mineral rights. And they're producing. There's some new lateral wells, 5 of them, matter of fact.
Oh, wow.
And I hired a landman right away, and it's been a real exciting venture to learn about the mineral rights that we acquired.
And just to share with everybody why that is so amazing in Texas, if you didn't know, we're a huge oil producing state. Nowadays, most of the time, you go and buy a piece of land, somebody's already stripped out and separated the mineral rights, meaning you don't have the right to pump oil from your own land. So the lucky happenstance of buying a piece of real estate that still has the mineral rights is massive and very infrequent in this state, at least. I'm sure in the Dakotas, maybe it's a little different, but here.
80% of the mineral rights had never been severed from the real surface property. And the landman we hired, he traced it back to the 1880s and came up. In fact, just last week, we got the operating company to put us in pay status.
Okay.
It took some time to get our deed even find out who the operator was of this gas. It's gas, by the way, not oil. Anyway,
Okay.
I didn't mean to get off the subject.
They say oil and gas. I don't even know. I know one you burn, the other burns cars.
Yeah, and some of them have some kind of oil associated with the gas.
I'm not going to try to figure it all out. So let's talk about, you're raising funds. There's a discount here. There's an immediate discount to fair market value. Plus I'm amazed that you can get basically a 50% return, even if the deal falls apart because the old owner pays you off. That's amazing.
Mm-hmm. Yeah, and that's backed by the state statute. I mean, they cannot redeem it. We're the new owner immediately. We have what's called a sheriff's deed without warranty. So there are some nuances. If, for example, somebody wasn't named in the lawsuit, some heir popped out of the woodworks, they could redeem the property, and they have up to, even if it's a 6-month redemption period, they have up to 12 months to make a claim, which is why there's some problems with getting title insurance on the property until 12 months have expired from the date of the recording.
Which makes sense, because you can't give clean title because it's not clean title as long as somebody has a right to take the property back.
Mm-hmm. Yep.
All right. So, what kind of discounts to current fair market value are you seeing when you're out there picking up these deals? And I see that little smirk, so I know, I'm hoping you're willing to share it.
Yes,
because it is so attractive.
I do want to go back to the point. There's a lot of promoters out there selling courses, doing road shows, and educating the consumers on the benefits of tax deeds. I won't mention any names, but I've been to a couple of them, and it's all legal. I mean, it's the statutes that provide. Ad valorem property is the highest priority tax on the highest priority lien on the property. Thus, why do your lenders require you escrow the property taxes? There's a reason. So it's very high. It's higher than the mortgage. Mortgages are wiped out, extinguished when the property is sold at a tax sale.
Wow. Okay.
Very important. The only thing that doesn't extinguish is something I call weed liens, which is not what you're probably thinking, but the municipalities, if they put a lien for the mowing the grass or a demo lien, those survive the sale. So that's an area you need to be aware of if you're doing it yourself. But my point is, a lot of people will learn and see the upside, and they'll get a list and they'll start going and bidding, and often a large percentage of the property gets pooled the day before the auction, the Friday before the Tuesday sale, because by nature people are procrastinators and somehow they come up with the money at the last minute to pay the taxes. My point is, you can spend a lot of time doing your diligence underwriting these properties and never even have a chance to bid on them because they get pooled before the sale. People get frustrated, and so that's where we come in. We're offering a passive investor, somebody maybe even out of state that likes some exposure to Texas in their portfolio, and interest in the properties we're buying between 20 and 30 cents on the dollar.
Wow.
And our niche is raw land, infill lots, small acreage tracts. We've bought 10 so far. Only 2 of them have a structure on the 10 properties.
Okay. Why are you finding that raw land is a better angle? Is it mainly because it's less likely for it to be cured, or the upside potential of developing the land, or luckily finding some mineral rights?
We're studying that mineral right avenue all the more. In fact, Nate, you may recall your team and I, we debated whether we should disclose the mineral. Do you remember when we were doing our disclosure Form C, and I worked with your team, Jeff, and we went round and round. Do we want to mention the mineral because that's an area we want to learn? and we decided, yeah, it's okay to mention it, but not focus on it off the get-go, because you remember any of that?
I don't remember that, but we do so many of these deals. But it is an important thing for that you're bringing up, that if there's a possibility, you disclose it, you talk about it, but it's a possibility, not a guarantee that that's part of the business plan. So it's more of a disclosure of this may happen, not we expect this to happen. So it's a little bit of a difference. So I understand why there's a debate there.
Well, should anybody dive into the 130-page Form C, they'll see at least a sentence or two about the mineral rights. It's not a focus, hasn't been, but it's certainly becoming more interest. And I've spent a lot of time the last 90 days with landmen, attorneys that know the nuances, and it's so complex.
Oh yeah,
mineral and gas. Anyway,
yep.
So we're offering in our platform RegCF to non-accredited investors. They can come in with as little as $2,000. In fact, what you're popping up here is our offering portal, which we're required. Nate, you may want to speak to that requirement a little bit. This is where all the investment money has to be placed through this investor portal. And on this portal, you'll see these disclosures that were generated by Crowdfunding Lawyers 101, and we have audited financials. Goes a little bit over. There's a good map. If you focus on that map, that shows the redeemable deed states. And then some of my track record is on there. So far we've raised $168,000 on top of the startup capital we raised in the management entity, and we've deployed just about all of that. We've got somewhere around $700,000 in market value. We're meeting our goal at 20 to just a little over 20 cents on the dollar, with the exception of one property. And I'm happy to go into the details on that one that is outside of our goal of buying at 20 cents on the dollar.
Sounds good. And I dropped this URL, the website address, right into chat here if anybody wants to check this out. And I do want to bring up, as John did, this is called a regulation crowdfunding offering, which allows you to raise capital from absolutely everybody, tends to have a lower minimum investment. So it does give you the opportunity to cast as wide a net as possible, but it's required to be through a FINRA and SEC registered funding portal. So what we're looking at here is the core tax deeds funding portal that does allow everybody to invest. But if you're ever interested in doing your own real estate fund, targeting these types of opportunities, I mean, I would say first step is to reach out to somebody like John that has the experience, and maybe he's interested in dipping his toe in joint venturing and working with more people, or otherwise that's where the setup looks like with the offering and the fund online, that the investors can do all of their contributing, all of their due diligence, getting to know the investment itself. And then as part of this, you have the description of the investment as well as all the documentation that goes along with it. So just wanted to bring that up just because we're talking about it.
I'd like to mention there too, Nate, we did come up with some incentives if people come in at a different level at 15,000, or someone is in position and wants to deploy 50,000, 50. We have some bonus member units that you would get 5% in if you came in at 15,000, or if you get a 10% bonus member units if you come in at 50,000. Did I say that right? 10%? No. So those are,
in a general sense, and this is important for everybody to know, if you're doing a regulation crowdfunding fund or offering, and very similar to how John structured this, you always want to incentivize the larger investors. So giving a little bit more if somebody is investing $50,000 or $100,000 to push them into that higher class where maybe they're getting a little bit more profit or a little bit of a higher return, just to incentivize those larger investment amounts. So important and smart to include. So apparently, John, you're getting good guidance.
Well, thank you. I've had, again, this is my second fund that you helped me create. Happy to share my first go round if that's of any interest at this on this call.
For right now, let's focus on the tax deeds, only because it's an area that honestly just not enough people know about. Mm-hmm. And kind of like multifamily 15 years ago, it was honestly a small niche that not a lot of people played in the sandbox until it really did well. People started educating on it. There was a higher focus on it. And that's when values went through the roof. Right now, at least in my opinion, with the tax deed sales and opportunities, this is like multifamily 15 years ago. Just not a lot of people actually know about it, know how to do these deals, how to maximize the value of it. Even if you don't keep the property and it gets rescinded, or the seller gets the right to get it back, you're still getting great returns. So that's really why we're focusing on this today. And John, you're the right guy to help share that. Now, you brought up, you do have a lot of boots on the ground. You also brought up something before we started talking here, and I think it's really important. You're not allowed to do a full due diligence in terms of what kind of carpet is there, what's the interior look like. Sounds like there's a lot of limitations, and I know this is always with the auction markets. Can you speak a little bit to the, well, higher risk, higher reward, but the risk of not being able to go in the properties?
Yeah, so in one of our purchases was a structure, a home in Corpus Christi, Texas, and we paid $14,000 some change for that house, about 1,500 square feet. We thought we'd be able to renovate the property. However, the day of the auction, I got a call from the law firm saying the owner's son is wanting to bring the money in, and it's too late. They can't. We won't accept it. So expect to hear from them. They're planning on redeeming it. So I reached out to the owner. Even, I don't know if it was the day or the next day after the auction. Began having great dialogue with her. Interesting case. She lived in the home, raised her family there, and left the house like 6 years ago and moved across the street with her father and never went back in the house. All her possessions were in the house. I got pictures. We spent a pretty good amount of money just getting her possessions out of the house. Long story short, we began the demo. She agreed to sell us her redemption rights. This house is homesteaded. It was her homestead. And that's a whole nother area we don't have time to talk about today. But these taxing jurisdictions, in my opinion, they don't do their job. They're supposed to go out every 3 years and physically inspect the property. That's not happening.
That never happens.
No.
Zillow. That's how the comptroller around here does their tax evaluations.
Oh my gosh. So this place was pretty poor shape. We ended up, you're not allowed to go inside the property before the auction. So you could buy a pig in a poke, and we got 1 out of 10. However, I spent a couple $1,000, hired a crew to put a tarp over the roof. There's 4 or 5 holes in the roof. And then we removed a lot of sheetrock, ceilings, floor, subfloors, and did a full inspection of the structure, and then determined that it's unfortunately a tear down. So we got $14,000 in the purchase. We're paying her $250 for her right of redemption. She's going to, I've seen a draft. We haven't executed it yet, but one of my managing partners, by the way, is a real estate attorney in Austin, 44-year practitioner, whose father was a dean of law at University of Texas from 1947 to 1977. So I got a pretty sage real estate attorney on my management team. he's drafting that document. He found out from the title company that they will issue a title policy if we get her to sign her right of redemption, and she's willing to for $250.
That's amazing.
We are going to end up spending $5 or $6 grand in the demo, and still be under the value of the dirt once we do the demo. And I want to do the demo before January 1 because the new assessed values will come out as of January 1. And we want it to be, I've already protested the value, got it down from 100. Oh, that's where I was going. They had this property assessed at $127,000 on the tax rolls. Vacant, dilapidated, and I protest. I got it down to 77,000, but next year we'll get it down to the value of the dirt, which is about 30,000.
Yeah, especially if you got to remove the structure that the entire value is based off of.
Exactly. Yep.
So this is a unique situation. Has this been out of 10%? Is this kind of the par for the course, or more of a unique situation?
When my experience and my focus, it's very unique because we're, again, not focused on improvements. We're focused on commercial raw land acreage. So it's a rare event.
But it's very possible that it could occur more often if you were looking at more of the homesteaded and residential properties.
And
maybe not.
If we were to buy a commercial piece that had a laundromat in the past, had some environmental issues, that's all part of our underwriting. Do our diligence up front. As far as on the land, I'm a former realtor. I feel comfortable trespassing on the property, right or wrong.
I'm an attorney. La 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 la.
You have a little more opportunity to inspect on unimproved property than you do improved property, I guess is where I was going with that.
Okay. In terms of your own business, is your target to sell off the raw land, to develop it, or to find some developer that just wants a joint venture? They do the build, you get part of the big chunk of the benefit.
Yep, all the above. However, our business model is primarily buy it 20 to 30 cents on the dollar and sell at 70 cents. We don't want to really hold out for retail because of the nature of raw land and dirt. It's not as fast moving as improvements. So we want to price it below market value so we can buy and sell and build up our fund, grow it accordingly. But we will hold on. I've got 2.6 acre parcels that are in the pathway of some pretty good development down around Rockport in Aransas County that are contiguous. So it could be a 5.2 acre parcel, and we got it at very nice spread on this acreage.
Are they close enough to the markets that residential home builders is still a good prospective buyer? Because even with where real estate's been, it's a hot market to build neighborhoods right now.
Absolutely. In fact, there's a whole nother area of property called struck off. So when it goes to auction, if nobody bids it, and it happens a lot of times the opening bid exceeds the value. So there's no buyers if anybody does their diligence. And those get struck off to the taxing jurisdiction. And there's a lot of inventory available. You can negotiate. They can take less than the amount of taxes. So there's a lot of potential for infill lots. And that's part of what we're going to grow into, is acquiring some of these struck off properties in inner cities where we can put in tiny home, projects. And there's certainly a viable market there for acquisitions.
Makes sense, especially if you're in the hill country or a high cost area. They're desperate for housing. So doing these tiny homes, easy, cheap way to get involved. You can have companies like Boxable that will literally deliver the house. All you got to do is put up the walls.
Yes.
I absolutely love the business.
Yeah. We bought one in Williamson County. I'm sure you're familiar with Williamson County. It's where the new Samsung plant came in Taylor. We're about right up the road from Taylor. We bought a nice lot, and shocking, Taylor was like on the way to nowhere before
Still
Samsung
is.
put no, you can get out to Rockdale and East Texas on that highway. But anyway, yeah, it's gone crazy nuts. A town by the name of Berlet, just north of Taylor, is having $400,000 subdivision homes coming in because of this Samsung project.
Wow.
And
Well,
we bought one. We bought a lot, half acre in this Williamson County for $9,200, and it's on the tax road. It's worth 45 to 50K all day long.
I mean, if anybody is like thinking about these numbers, something's worth $100,000, you're spending 20. Your goal is to sell something that's worth $100,000 for 70.
Mm-hmm.
Like, here's where this massive level of opportunity is. But let's talk about what you need. You need the boots on the ground. You need to have the education, knowledge, and experience, and you need to have the capital. And that's where setting up your own fund to be able to do this. But if you're wanting to get more involved with this, whether you're looking to create the boots on the ground or you're looking to be a funding resource, I definitely suggest everybody that is interested in this asset class to reach out to John Berlet. John, do you have an email that I can just, if you don't mind, I'll throw it in chat so people can
absolutely.
reach out to you
John,
directly.
John at core, CORE, tax deeds, plural.com. And the core acronym is cash out real estate. So this is really a short-term play in the grand scheme of things. We don't want to hold these properties very long. We want to generate some profits and distribute them within the first 18 months is our goal. And we're coming into being able to put some of these properties on the market here. And the first one will have the 6-month redemption period over in November. And it's we've got a lot of upside in it. Do I have time to go through that business split?
Yes. Yeah, please do.
Okay. So we got it set up where the management entity, which I manage, takes a total of 6% of the profits. 2% when we buy the deed, the property, 2% to manage it during the holding period, and then 2% on the sale. So that's our incentive. Then the passive investor, the investor in this core tax deeds crowdfunding offering, receives a 12%, the first 12% of the profits go to the passive investor. At which time, and some profits got to be generated, of course, before you get your 12% pref. But once we generate profits, and we feel like that's going to happen sometime in Q2 next year, then we split until the passive investors made whole. They get 60% of the profits. Management team gets 40%. Once they're made whole, we're going to a 50-50 split on the profits. So it's pretty generous, in my opinion, based on the amount of work. You're putting in capital, we're putting in the work. We're taking 40% of the profits until you're made whole, and we take 50% of the profits.
Let me ask you this, because I think the structure makes a ton of sense. Are you having a repayment of the investors so that preferred return, which 12% is quite high, that will continue to go down where eventually you are just sharing profits at the end of the day?
Yes, that's the way it should work. The first 12% gets paid out once they are made whole. Say they put in 10,000, once they're even, then we're splitting any future profits, if any, 50-50 from there on. And then at some point in time, we'll liquidate the entire portfolio, discount it, and distribute any proceeds at that point.
And I think that brings up a real good point about what's the time period, the average estimate for, let's talk raw land, a turnaround time from acquisition to repackaging, repositioning, or resolving any of the outstanding issues and getting it for sale to potential buyers?
I think that realistic time frame is 18 months.
Okay.
Stuff happens all in the first 6 months.
Mm-hmm.
A lot of continued expenses with property taxes are going on. We have, in the case of the acreage tract with the mineral rights, we've incurred some additional expenses, hiring a landman, hiring a attorney that knows, statutes regarding tax sales and mineral rights. So to answer your question, I believe, for example, the second property we bought that had an improvement is in a small town called Sinton, Texas. And it's in San Patricio County, a county seat, and they just opened a new plant there called Steel Dynamics. Big factory, lots of jobs, and 2 new subdivisions. This is a dried up, dead town called Sinton that some new plant came in, opened about a year ago, and created a bunch of jobs. There's 2 Horton subdivisions, D.R. Horton subdivisions going in this little town of Sinton. Well, we bought one house. It was real hidden, bunch of trees overgrown it. Bought it for $24,000, non-homestead. The story on this property is the former owners had deceased 5, 6, 7 years ago, and the grandchildren had been living in the property up until the Sunday before the auction on Tuesday. When they, according to the neighbor, after I bought it, I went there that day, and the neighbor told me, yeah, they left Sunday, went to West Texas, and believe it or not, Nate, they took the front door with them.
Oh, wow. I'm not surprised.
There's no front door, but they left about a $1,500 stainless steel refrigerator in the house. Anyway, we've spent probably $35,000 since May. New floor, new roof, new deck, kitchen, bath, and that redemption period's up November the 17th.
Okay.
We're going to be able to, we've got a $125,000 home on our hands now that we paid $24,000, and then we got another 35 in it. So somewhere around 60 in it, and it should sell for around 120.
And you're looking for 100% gain on a matter of a 12-month time period.
Yep.
That's
and
huge.
I feel comfortable spending the money on this improvement. One, it was needed. I mean, the floor was unleveled, the roof was in bare repair, and it's considered repair and maintenance. I heard the history of the children. Basically, they were squatters, even though they never go through probate. They really probably were entitled to the property if they'd taken the time and spent the money with attorneys to get their legal ownership.
Not if they're squatters. They're just hoping to get all that they can get for nothing.
Exactly.
So I know that is because there's a home there, there's a structure there. When we're talking about raw land, I mean, I know it takes 6 months, sometimes 12 months, once you get something under contract to actually close. And just so that everybody understands, why is it so different? Generally, a builder or developer wants to make sure that they have their building permits, that they have zoning. They call it the entitlements. Can they even build, or are there other rights, or is there a cloud on title that stops them from being able to build and sell? So a lot of these things just simply take time to organize. And that's where, if you're selling a home, maybe it's sold in a month or 2. But if you're selling raw land, it can take up to a year minimum, even when it's under contract.
Or it can take as soon as a day. If you price it right and you have all the diligence done, and it's in an area that doesn't require zoning or this and that, there's a big competitor, a hedge fund out of Houston that we're bidding against in some of these counties every month. And their whole model, they're very successful. They buy and they owner finance the land and the structure. They do nothing to it. They don't even paint it or clean it or mow the yard, and they owner finance it 12% interest. So, there's other just options to dispose of the property in a shorter time frame. But I totally agree. If it's a desirable piece that somebody's going to pay a desirable amount of money for, they're going to take time to do their diligence and be sure all the zoning entitlements are in place.
And I think you really nailed it with, if you can buy it for 20 cents on the dollar, heck, you can sell it for 40 cents on the dollar, still make 100%, and everybody comes out ahead.
Mm-hmm.
So it is just such a ripe market for investing, for really focusing on, and frankly, not a lot of people are doing it. So I really, John Berlet, really appreciate you coming on today and diving in a little bit deeper and sharing a little bit more about this area that frankly, not a lot of people know.
I'm super excited to have me on after all this time. I watch your podcast pretty regular. You got great content. I'm glad to be a part of it and look forward to answering any questions any of your followers may have or your associates.
Really appreciate it. Well, we only have a couple of minutes, so if you do have any short questions, drop them in chat. Otherwise, John, do you have any final thoughts or things you'd like to share?
Yeah, let me talk a little bit about OZ, opportunity zones.
Oh yeah,
because
where we started many years ago now.
2017 Tax Cut and Jobs Act was put in place, something called qualified opportunity zones, and they're amazing. Think about it. Most of real estate people are familiar with 1031 exchange, right? It's like kind. You have to have a real estate to real estate. In the insurance and the life insurance annuity world, it's called 1035 exchange. You have to exchange your gains from a life contract to life, annuity to annuity. So I know both of those. And those are IRS codes, by the way, 1031 and 1035. Opportunity zones are like a 1031 exchange and a Roth IRA got married. They had a little kid named Oz. It's huge. It's a capital gain incentive that applies long-term game, short-term game. If you sold crypto, if you sold a company like I did, if you sold stocks, anything subject to capital gains, the window's kind of closing down unless Congress acts again. It's going to end in 2026. Huge amount of money is moving into these opportunity zones, and I have one that's looking for a co-GP, a JV partner who has a development experience that I'd love to share. We're debt-free on this project that's 3 blocks from the Bay, 9 blocks from downtown Rockport, and a huge tourist destination for San Antonio, Austin, and Houstonites.
Love it. And to get a little bit deeper into what these opportunity zones, the OZ is, now the governor of every state, this is in all 50 states, designate areas that are economically depressed or just needs help. And so this is an IRS program that allows people to invest their capital gains into these areas. And well, I guess the capital gain step up really isn't available anymore. But if you hold on to the asset for at least 10 years, you get all of the gains, capital or tax-free, capital gain free. So that still to this day is a huge benefit.
Yes. Yeah, and there's some wildly successful funds out there. And then there's some like mine kind of struggling, trying to, primarily because of the economy's been challenging for a ground up development. And my project is a hospitality play, can pivot to multifamily. And again, looking for someone who may be interested in exploring some conversation that help us get to go vertical. We're almost shovel ready.
Love it. Well, I guess there's a number of different avenues and areas of really the more unique and different real estate plays. If anybody that's watching, they're interested, just reach out to John direct. As you can tell, he's a nice guy.
Thank you. Thank you very much.
Well,
to be with you on this call again, Nate, and thank you for all your help with the legal expertise and guidance you provided.
I love it. Well, John, thank you so much for joining today. And for everybody else, hope you have a great day. Looking forward to seeing you next Wednesday, same time, same channel. Talk to you soon.
Wonderful.
Bye, guys.
Bye-bye.